Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I would like to welcome Andrew Bonfield. Thank you, Andrew, for joining me on our Fortuna Advisors podcast, Create More Value.
Thank you, Greg, for having me.
Andrew Bonfield is the CFO of Caterpillar, one of the great success stories in value-based management. He is responsible for financial services, financial products, enterprise strategy, and information technology. Andrew joined Caterpillar in September 2018 and brings more than 3 decades of financial expertise to the role, most recently serving as Group CFO and board member of National Grid, a British multinational electricity and gas utility company. Prior to that, he was CFO at Cadbury plc and served as CFO at Bristol Myers Squibb. Before that, he was at SmithKline Beecham, which is where we met decades ago. Andrew is a chartered accountant with a BCom degree from the University of Natal in Durban, South Africa, a country I did business in for a few years in the early 90s. Andrew also serves as a non-executive director and chairman of the audit committee at Reckitt Benckiser Group, a British multinational consumer goods company. From the end of 2016 through the end of Q3 of this year, 2024, CAT has delivered over 2.5 times the cumulative total shareholder return of the SPY ETF that tracks the S&P 500. In the face of such extreme success, how would you describe your strategy for long-term profitable growth?
Yeah, so Jim Umpleby is the new CEO in the beginning of 2017, introduced the Caterpillar's new strategy, and he very simply wanted a strategy that everybody could understand, so he put it on a single page, and at the heart of that is actually profitable growth. Profitable growth is an interesting concept for many companies because it's neither grow margins or grow top line. Actually, is trying to grow growth. So both organic growth and actually margin expansion was part of that strategy, was the heart of it. Effectively, what surrounds the strategy is, things like company's values, the code of conduct, and the way that the company has operated for many, many years. But effectively, there are 4 pillars. There were 3 originally, and 1 has been added. Those 4 pillars are expanded offerings, operational excellence, services, and the new one, which is sustainability. And those all form part and covered by the operational and execution model.
So what has been the high-level result of all this in terms of, performance?
Really, really strong, not only strong performance, but also actually really strong financial operating performance. So since I've been here in 2018, profit per share has nearly doubled. Free cash flow is very strong. Last year, we achieved best ever result from a free cash flow perspective, $10 billion. And what we've done is, with using the O&E model, effectively focus on what we call OPAC, which is operating profit after capital charge. It is, as you said, an EVA type approach, economic value added approach. And that really strongly correlates, we believe, to cash flow, which obviously most strongly relates to total shareholder return. And that's been the driver behind the success.
So let's talk a little bit more deeper about this operating and execution model, which is sort of famous among people that are value-based management parties like myself. How does it actually work? What are some of the ways you put that discipline to work?
Effectively, the operation and execution model is the heart of what we do. So it is the focus for that long-term profitable growth. Effectively is a disciplined investment framework. It's going down to by market, by application, by product, really understanding what is happening and how value is being created in the individual business units and in the individual product lines, by product, by market. So then we can actually work out where we need to invest and where we need to fix as part of that strategy in order to make sure that we're profitable and driving OPAC across the whole organization.
So you actually calculate this operating profit after capital charge, this OPAC number, for a particular product in a particular market and use that to guide, whether that's a good area to grow or not. Is that, am I understanding that correctly?
Yeah, effectively, it's trying to use facts and data as a basis of making those determinations. So yes, there is obviously some element of allocation in that,
Mhm.
which obviously is, sometimes creates a little bit of a challenge. But the reality, the focus is to make sure we're looking at everything across a level playing field,
Mhm.
across the whole organization. And that then enables you to make better resource allocation decisions. So effectively, the heart of the O&E model is about where do we allocate our resources behind the greatest opportunities for long-term profitable growth. And where do we take resources away from parts of the business, either then through then thinking about you know, restructuring them, or and if we can't find them through restructuring to find a way to profitability, actually approach a way to actually exit those businesses themselves. So that's
Mhm.
been part of that strategy, which has been ongoing. And this is done on an annual basis. So it's an ongoing basis looked at.
Mhm.
And we do our O&E reviews across the year, but for each of our divisions. And each of those divisions will come present, and they will have a level of detail that then we can actually go look through. And also making sure we understand the market itself. So part of the understanding is where our competitive position is relative to others in that market and how
Mhm.
that impacts profitability as well.
So the interaction between the competitive position and the OPAC is probably pretty strong. Where you have a stronger competitive position, you probably have better OPAC, and vice versa.
Yeah, effectively, like any manufacturing company, we get the benefit of operating leverage. So you spread your fixed costs over a greater base. So where you get
Mhm.
volume benefit, obviously that creates an opportunity to grow OPAC faster.
Mhm.
And that really is simple, as long as you don't have to continue to build extra capacity. So, and that again, always is a reminder, one of the things that Caterpillar would have done historically would have been to chase the business cycle. And as demand continued to grow, what would happen would then the business units would find it quite difficult to meet production needs. And therefore, they would then actually say, we need more capacity, and
Mhm.
actually overbuild capacity because they forgot the capacity has a memory. And that's the benefit of having a capital charge, which effectively says every dollar you invest, you have to get a return on that dollar. Otherwise, it's excess, and then that's a problem. So effectively, one of the things we've found is we've actually reduced the amount of capex needed in the business as we've gone up. We've
Mhm.
closed a lot of old capacity down, and at the same time avoided restructuring charges because you don't have to shutter that capacity in a period of time where demand is weak.
Mhm. Yeah, and managing through the cycle is something Caterpillar does brilliantly. It's very easy to see, from the outside. I want to go back to something you said before. When you talked about OPAC, you said there's a certain amount of allocation required. And when we talk about taking, our version of OPAC, our economic profit measure, down deep in the organization, that's usually one of the stumbling blocks in many companies. They say, oh, if you have to allocate so much cost and capital, then we're just going to argue about the allocations all day long. But it's clear that Caterpillar doesn't just sit around arguing about the allocations. You move on and use it for decision making. Is there any advice you can give to people that are considering that on how to make it about business decisions and not about arguing about the allocations?
Yeah, I mean, then I would say to you, there are times when we have arguments about allocation. So I would like to say, yes, we do, I think, a better job at it because it's been a more consistent process and it's been something we've looked at over a number of years.
Hmm.
One of the other things we've done is we've actually delegated decision rights down into the business units themselves. And that delegation actually enables them to have a much greater control over what their cost base is. So even if it's an allocated cost, like, for example, network costs, they actually understand how that network is based in their individual business unit. They don't have
Hmm.
full decision rights, but for example, they will have a greater degree of autonomy, for example, deciding what applications are going to be put in their systems. So
Hmm.
again, that just creates that linkage between decisions they're making and costs that they bear. Obviously, where you get into more of a difficult discussion is where there doesn't seem to be a real rationale for that. So that's the bit where obviously everybody has the challenge. When
Hmm.
we first worked back in the Smithfield days, you remember that was the conversation we had around R&D allocations were
Yeah.
much more challenging because business units and in a pharmaceutical business, the margins are much higher, it didn't really make a difference anyway. So an allocation was almost irrelevant. So it becomes, I think it's, obviously manufacturing is a different environment, and it does lend itself because it's much more capital intensive. And then also lower margins. So therefore things do enable, and people want to understand how they make their business profitable. So some of the allocation, I'm not saying we don't have debate, but they understand that those allocations are needed to make them understand how they fit in the whole of the enterprise and have that enterprise view in that perspective.
You mentioned R&D in the context of pharmaceuticals, but obviously, maybe not to the same degree. But R&D is very important in your business too, because you're developing new products, especially with global tracking, GPS tracking, and things like that. There are things that have been added over the years to make products better. Is there? Do you think there's enough of an emphasis on spending on innovation? It seems that way from the outside, but some people fear that when you go to something like an EVA or your OPAC, that's going to lead to less innovation. What's been your experience?
Yeah, actually, I mean, one of the things that's interesting with the R&D is percentage of revenues does fluctuate a little bit, obviously, because of effectively as revenues grow, you have a little bit more volatility in revenues versus a consumer products company or a pharma company. But actually, as far as actually absolute dollars are concerned, actually, it's pretty much a consistent and a growing number within the P&L. And, one of the things we've done is we've also made sure that we continue to look at how you make those R&D dollars more effective. So one of the things we've done, for example, is look at engineering. So we had a lot of our engineering based in very high cost jurisdictions. And actually where we added a little bit more incremental engineering, particularly given also, there's an issue about STEM and the number of engineers qualifying in, for example, the US and Europe. Means that we're looking at places like India and China for some of our engineering expertise, because not only is it cheaper, but there's also greater volume and able to get that and get bigger bang for your buck and stuff like that. So, we have not taken investment decisions off the table. I mean, one of the things, obviously, when we do an investment proposal, one of the things we obviously do is look at the NPV and same as everybody does with an IRR and so forth. But there are certain times where it doesn't lend itself to that sort of rigid process. Let me give you an example. E-commerce, for example, it's very obvious to all of us that people would like to be able to transact on their cell phone. That is something they would like to be able to do. If I went to do my normal process of what we call our green books for an investment decision, for an e-commerce investment, I would probably be negotiating with probably 120 entities across the organization and getting them to agree what they think the incremental sales volume value would be. That was going to take forever and would have slowed us down. So what we said is, okay, what do we need to believe to achieve a return on invested capital above the cost of capital? What was it we would need to achieve in that case? And it became pretty easy to then back solve the problem and actually say, okay, I'm not going to go through this negotiation phase. I'm going to go direct, and we made that decision. So again, I think it's being able to have the benefit of the O&E model is it gives you a framework which is really important for most of your investment decisions, but at the same time enables you to make flexible decisions around certain things we've decided to do. You refer to GPS tracking, connectivity. It's actually mostly done through cell phones, cellular data. But that's really important for us because, first of all, it enables us to track the machine, see what the machine is doing, enable us to look at what faults are on the machine, enable us to work with our customers and tell them, hey, hold on a second, you've done X number of hours. You probably need to think about some service associated with that machine, whether it be undercarriage or filters or some oil changes, hose repair, and so forth. So that gives us the data to enable us to identify the issue. At the same time, it also lets us know where the machine is and what conditions the machine's working in, so that then we can actually better help and understand and actually better serve that customer themselves. Because ultimately, at the end of the day, what is the most important thing for most of our customers? It's uptime and actually making sure their machine is operating when they
Mhm.
need to do it. I mean, one
Mhm.
of the things, about construction equipment, construction often is a phased process. So there's a lot of time where, for example, you'll grade. So you'll have the bulldozer going in and pushing the dirt. Then you go in with a motor grader to actually to, to to make sure it's flat. Then you go in with the soil compactor. Same
Mhm.
time, you may need a wheel loader to come in and actually move some of the excess dirt off the site. You can't, that is a process you work. So thing that often happens is the motor grader is standing by waiting to do its job.
Mhm.
If suddenly the motor grader is not available because there's downtime, that's bad news for that customer because it means a delay in the job. So it's making sure you have that uptime. And that is the sort of thing, again, connectivity, we charge a very minimum subscription to give certain data services back to customers. But ultimately, we believe the benefit to us, connectivity, is being able to help the customer be more successful, which enables them to buy what enables them to want to buy more CAT equipment. And that's the benefit of that. And also CAT services, which
Mhm.
are obviously where we generate more
Mhm.
profitable growth. So that's an organic growth opportunity for us. But it's one where we've taken the decision we don't want to return on a subscription model because if we did,
Mhm.
again, same thing, that would be a lot more challenging to get every customer to want to do that. The
Mhm.
landscape gardener who's using his skid steer to do landscape your back garden isn't necessarily going to want all of those services, not going to necessarily be willing to pay for all those services, but he gets the benefit of it by effectively us enabling them to say, hey, hold on a second, you need to do your oil change, you need to do your
Mhm.
change your filters. So all of
Mhm.
that is part of that strategy.
Mhm.
And again, just part of how we use the O&E model, and then also allow the O&E model has the discipline to enable process to operate, but then enable us to focus on those things which are most important from a strategic perspective.
Mhm. That's great. I want to do two things kind of at the same time. I'll ask two questions that are related to each other. Actually, I'll make a comment first. Your description of how you handled the e-commerce is it was brilliant, and I feel the same way. When you have trouble preparing a forecast, reverse engineering the minimum forecast, it's often easier to say, "Oh, we're definitely going to do more than that," than it is to actually pick a number. And I think that's a really great way to deal with uncertainty. Um, so I want to ask you to maybe, I know how economic profit works, and you know how economic profit works. But if you could describe the OPAC measure, how it's calculated, what are the components, and how it's calculated, that might be helpful. And then, are there any, types of decisions where you just don't think at all about the OPAC? You just make a decision on some completely different criteria,
Yeah.
completely different financial criteria. I mean, there are decisions you make for various reasons that are, good for other aspects of the business that are not financially. But are there things that don't fit neatly into OPAC where you have to use other financial
Yeah.
tools?
Yeah. So there's two parts. So yeah, first of all, OPAC, as we say, operating profit after capital charge, we do allocate and have an asset base for each individual business unit. Um, and we allocate a 13% pre-tax cost of capital to that asset base, and that would include their working capital requirements as well.
Hmm.
So fixed assets plus working capital, and now we use to calculate their capital charge for the entity that they're operating. And again, that just gives you, it's not a full economic value. We don't do things like some people will do, capitalizing certain things, and we do have depreciation rates that are slightly different sometimes in different business units, some accelerated
Hmm.
depreciation and so forth. But it gives a direction of travel, and it's a consistent basis across all the entities, which does
Hmm.
enable us then to at least look and assess. It gives a proxy for that cash flow, free
Hmm.
cash flow, which is obviously the key driver of the value that we create. And I'm sure we'll talk about free cash flow a little bit later. So again, that's just very simply the way we do it. We try to make it as simple as possible because obviously we wanted to make sure that people understood it. We do
Hmm.
have another measure we use, which is OPAC PV. OPAC PV is also the present value of future services revenues because obviously, like every other manufacturing business, services are an important part of your value you create.
Hmm.
And that obviously is a revenue stream associated with that. And obviously, the focus of there is about capturing as much of that future revenue stream as possible, because obviously that then creates more value for you. And it is not the sort of razor blade model of selling the razor at a discount in order to sell razor blades, but obviously services create value as part of that long-term stream that you've got.
Hmm.
So part of that has to be part of the thought process. So we use that measure as well. As regards where do we not use it? So let me take another example. We made an investment a couple of years ago, started investing in electrification. We looked at people's sustainability goals, what people were talking about, and we thought, well, we need to make sure we had battery machines available for customers, not to force them to take battery machines, but to have them available if they want them as part of their sustainability goals.
Hmm.
Interestingly, take up to date so far has been very, very low,
Hmm.
but we didn't expect a high level of take up. So that was an example where we said there's no, for us to try and estimate the future cash flows associated with the investment. We'll be here for the next 12 years trying to do the
Hmm.
calculations. And this, I remind you, we are an engineering company. That's harder Caterpillar. And engineers like perfect answers. So one of the problems with that, engineers and accountants together, mean you try to get people striving to perfection with an art plus a science. It's not quite the right way to go sometimes, Greg. So what that does mean is we sort of circumvent that in those circumstances and just say, look, there's no point trying to do it an NPD calculation. We know that the market, we're going to have to move that way. We know customers are going to want to move that way.
Hmm.
But obviously, we'll give them the option. We'll create the option for them. And that creates the sort of discussion point around that, rather than trying to get into how many units you're going to sell,
Hmm.
cost price per unit, what's when you actually are doing something from scratch effectively and have no idea what the real cost is going to be, nor what the price point is going to be when you're selling it. So again, that was just part of that sort of approach that we sometimes take.
Hmm.
So again, it's a stage by stage approach, but obviously just looking at it in a way that says, okay, ultimately at the end of the day, what is our objective? Our objective is profitable growth.
Hmm.
Ultimately, at the end of the day, how do you grow your profits effectively? That is by meeting customer needs. So you need to execute your strategy to doing that.
Hmm.
And is this part of in line with your strategy? If it's not in line with the strategy, then it's just a vanity project and you shouldn't be bidding. It's got to be aligned to those customer needs ultimately at the end of the day as part of that. And that's why, again, just having the simple strategy on the page, the gear that we use is really, really important because, again, it just enables everybody. You can always bring people back to that, even though there may be something which is outside the norm.
Hmm.
You are going to have, if we could all build businesses on spreadsheets, we'd all be billionaires and we'd all be incredibly successful. The
Yeah.
reality is, the world creates. You need to have some judgment factors. It's the same as what's going to happen with AI. Judgment still is going to be an important element of it. It can give you the base data, but ultimately, at the end of the day, you still need human judgment in that and make good decisions around that as best as you can.
No, that makes a lot of sense. When you talk about electrification decision, one of the things that we sometimes try to do with our clients in situations like that is to talk about it like a financial option, right?
Yeah.
You're making an investment that the immediate payoff might be small, but you're giving yourself the option of scaling it up if consumer demand or regulation causes a need later on to switch to electrification. You'll be way ahead of the game because you dipped your toe in the water and developed the products now. It's very hard to actually sort of quantify real options and like think about the input like you can on a financial option. But I find that to be a good framework for thinking about like what kind of probability of it becoming a popular product do you need, for it to be a good investment. And again, like we said before, that's sometimes easier than developing a forecast.
Yeah. And, I've seen that used, particularly in pharma, particularly where you're using
Yeah.
licensing products. That's a great way of doing it. What's the probability of it getting to market? What's the income stream? Back to your point, though, about back solving, everything then becomes a back solving exercise. And in order to achieve a 15% IRR, every single licensing deal I had, because everything at a certain stage has a thing, ended up with the peak sales of $1.6 billion. Why was that? Because $1.6 billion sold for 15% IRR equation. So you have to be a little bit careful. Again, I think that's where the
Yeah.
judgment comes in. If you give people a spreadsheet, they'll solve the problem, and that's a little bit where the judgment comes in again about how you execute against those models. So if you've got a spreadsheet which says, here's my OPAC, here's my OPAC PV, this is a business where generating OPAC on original equipment is quite difficult, but you can get a very good services flow. You may actually still retain that business again. That would be part of your decision-making process. However, if you've got a business which is requiring only OE to drive OPAC PV, that's going to come short some stage, because ultimately, again, it requires field population. And if you're not providing the services that the customers need, ultimately, at the end of the day, or your dealers aren't, how does that flow into your long-term ability to grow that business? Because ultimately, customer satisfaction is really, really key to how you grow businesses for the long term. So again, all of that has to be, I say, we always balance out. And I agree, the option model is one way we look at it. What's the optionality? That again, just what the O&E model does is it gives me the 85, 95, 90% of decisions which are, can be dealt with in that way, I can look at it, I can make decisions, I can test the assumptions, and it's very easy. The 10% of the stuff is the more difficult things. That's where we have to use, our intellect to try and actually work through the decision-making process. And that may be exiting the business, restructuring the business, what can be done, how does this look long term? Again, what do we have to believe to see this get into profitability? Do we ever see that being feasible? What is the history? So again, just asking those questions and probing, and that's part of the power of the model. I mean, and again, the success has been, significant margin improvement versus our history. At the same time, growing services revenues. So from we were 14 billion in 2016. Our services revenues are now 23 billion last year in 2023. So that's a huge organic growth option for us, and much less volatile than OE. So therefore, actually drives more stability and profitability. And then that's driven free cash flow. So we've increased our free cash flow targets. We used to say 4 to 8 billion. It's now 5 to 10. Again, and the thing about Caterpillar, and this is the bit that I think investors often misunderstood, and one of the things I've been talking to people about is we throw up cash throughout a business cycle. So even in periods of time when demand's strong, we'll throw off cash. Demand weak, we'll throw off cash, because we'll work down inventory and stuff like that. And it's a very strong cash generative business, and cash flows are a lot less volatile. What that's enabled us to do then is actually go into the market, buy back more stock, increase the dividend. So we've got a growing dividend at the same time, been a dividend aristocrat. At the same time, we've grown profitability. We're growing free cash flow, buying back more stock, and we reduced the share count by 18%. So again, that's all things where the O&E model has really helped, which ultimately has driven stock price. So since I joined in 2018, stock price has trebled. So since when Jim took over as CEO, which is when the O&E model took in, it's quadrupled. So that is part of, and that drive and that focus on shareholder value has been really, really important. And, really making sure. Now, are we perfect? No, we're not. No company is. Anybody who tells you that, that's, as you know, is nonsense. But again, it just gives us that framework to continue. And, there are occasional things that you sometimes come back to and say, the O&E model may have driven certain behaviors which probably weren't right. So we have to always make sure we're challenging people both ways, so that they're not doing things just to cut some small element of cost, which actually is actually really, cuts into the bone rather than actually, cutting away some of the meaty flesh on top. Right? So it actually gets into the real heart of the business. So we continue to focus on that.
That's great. I have one final question. So, how familiar are your investors and the analysts that follow you with your operating and execution model with OPAC? I mean, is that something you talk about a lot with them, and how do they feel about it?
Yeah, so first of all, OPAC is a measure for compensation, so that's definitely in the proxy and it's talked
Hmm.
about, and obviously people are aware of it.
Hmm.
We don't discuss it much when we're talking about it to investors per se, but we talk about the O&E model and how that has driven changes. So the O&E model has driven a lot of change in the way that we manage the business as well, just not purely just by products and things like that. So, for example, I'll give you another. It's the one we talk about to investors a lot. Again, if you think about what happens when demand starts to grow, we are a dealer model. So dealers operate, and so we provide inventory to our dealers. Dealers sell to the end customer, and they service the end customer. What happens is, as demand tends to surge, what happens is availability is still, we're still ramping up availability. Availability is here. And so one of the things that used to happen is, factories start ramping up, dealers see availability still going, so they basically put in more orders because effectively what they're trying to do is to make sure they get slots. Then we
Hmm.
start catching up, and then dealers drop their order rates immediately, particularly in
Hmm.
construction, because they don't need, and they've got availability is free now, so they don't need to build stocks. So what happens then is we've got caught here, and we then have to take down. So one of the things, for example, through our sales and operating planning process, and again, this comes back to effectively using OPAC and the O&E model. We're effectively now trying to manage that much tighter to avoid some of those, the up and down turn. And so
Hmm.
one of the challenges we have, and quite often have with investors, is, well, the level of dealer inventory is increasing, so therefore at some stage that's going to be a problem.
Hmm.
Well, no, it's increasing, but we're now keeping it to a much tighter range than where it was historically. And in the context of a group that's got $60 billion plus of revenues, it's actually quite a small number.
Hmm.
The amount of focus sometimes we get, particularly from those who are on the shorter end of the investor spectrum, is disproportionate. But again, just trying to explain some of that, again, that discipline, because ultimately, again, that helps your cash flows, which helps drive shareholder value. Because what you
Hmm.
don't want to do is overbuild. Then you get stuck with a lot of, either dealers get stuck with a lot of inventory, or you get stuck with a lot of inventory,
Hmm.
finished goods inventory. And then that's the worst of all worlds, because your production cuts become much, much greater. So all of that about managing is much more part of that thought process.
Hmm.
And so it's, again, just trying to make sure we use all of those things
Hmm.
in the way we actually make decisions. And then obviously talk to investors about it, because ultimately, at the end of the day, what we say is OPAC correlates to shareholder value.
Hmm.
And we believe with, that correlation has worked really, really well. So again, just trying to keep all of those things. But obviously investors, you know, think about it in terms of the output rather than the input. So
Hmm.
OPAC in a way is an input measure, which is probably
Hmm.
more for management. The output measure is free cash flow in a way, which is obviously the most important thing from the investor perspective.
Hmm. Hmm. Well, this has really been great. Any final thoughts?
Well, no, just, I mean, it's been really, really successful. And I think one of the things, it gives me, a lot of joy about is actually seeing this actually operating. I mean, we tried, as we talked, we tried this 20 odd years ago back in my Smith Klein days, and couldn't make it work.
Hmm.
But actually to see it in operation and to see it being so successful, and actually to see the results as a result of that, has been phenomenal. And, helped actually not only execute the strategy, but actually deliver the performance that Caterpillar's done, which is, the team deserved a lot of credit. A lot of the building blocks, as I say, were put in place before I joined.
Hmm.
So it was a joy to come in and actually be part and see some of the success of some of the outputs. So
Hmm.
that's really been fun.
No, it's really been a really great story to watch. A very, very great success story. And I really thank you very much for joining. I really appreciate it. So we've been speaking with Andrew Bonfield. Thank you, Andrew, for joining us for this very important conversation.
Thanks, Greg.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.